All right. DIS, Walt Disney. That's a YouTube viewer request. And I did oblige New York Stock Exchange, Consumer Cyclicals Broadcasting. And man, when I popped up that monthly candle chart, first thing you see is that thing has resisted pretty damn well. The market turmoils. Look at that. Walt Disney, look at this crazy base right here. Wow. Multi-year base broke out. Broke out that multi-year base. 12-month moving average going up. Test. Oh, a little dip below, but still closed above. That's an awesome stage 2 to have been at. Movement gets exaggerated. Huge red candle. And that's the warning sign, guys. Those huge red candles, how much percentage? 15% in a month, 15.72% a month. Especially far advanced in the incline. Gap down. Close back above. Sellers coming in. You have that long wick. Back down below 12-month average. And that's the damage. That's the warning signs. Okay, I need to get out of this. This is what you want. Small, gradual steps. Some volatility back to the 12-month average. But when you start seeing these huge moves, that is more a negative sign than a positive. And what happened after that? Well, since it reached a high in August of 2015, man, 2 years and a half, guys. Still haven't overcome those highs. Sideways move. You get whipsawed left and right. And yeah, it's not looking too good. Holding strong versus the SPX, so definitely not a short. But there's damage that was done here. And it's just trying to figure out what to do next, guys. So I'm just going to identify my closer monthly defined support and resistance. And these are my levels I'll be looking at. And here, there's another one right here. Oh, make a straight line. There you go. So we're going to zoom in on the weekly and let's see what we're dealing with, guys. Always get more details, more noise on smaller time frames, but to fine-tune an entry, the weekly is, the smaller time frame is pretty good for that. So look at that. You see it right away, outperforming the SPX. Not a stage 2 breakout. Overall market conditions dragging that down. See here, you could have had an option. Right here, you had the volume. Look at that candle. So right here. That's why you always have to look at the weight of evidence. If you'd be just looking at the weekly, say, hey, Pat. Oh, no. Yeah, here. Have the almost twice the average volume of the previous 4 weeks. Starting to outperform the SPX, going from a halfway line to positive territory. Oh, yeah. Stage 2 breakout. Well, remember here, that's my monthly defined breakout line. Monthly defined resistance. I'm defining some more. And after that, breakout, try to go through, pull back really deep in, not a good sign. Volatility, and never made it across that monthly defined breakout line. And what happens in the meantime is you're starting to define your own monthly defined resistance right here. So you see that's the energy, those weekly, those daily closes trying to go above, breaking out on the weekly, not making quite out of the those all-time highs. And after that, oh, no, close below. Next month, try to go above. No, close below. Well, you're starting to define more monthly defined support or resistance, sorry. And after that, didn't quite make it. Sucked back down below 30 average. Huge red candle again on increasing red volume. Not a A++ setup. Not a... that's not how you want your stage ones to set up like. You want them to be tight and slowly less and less volatility, coiling up and then exploding. So the less chances when the overall market, the index, the sector you're in, the industry, when they're going down, even if you're outperforming them, they're muting your stage 2 breakouts. They're creating volatility in it. It's not the optimal environment to be able to want to go long. You're just not putting your chances of having a meaningful long trade, long stage 2 in your favor. And right now, what's happening? The price action going back down, buyers coming in. So it still wants to outperform the SPX, but now you're below the 30-week average, and you're starting to range in between monthly defined support and resistance. So can look at stage 4. Well, look, you're in no man's land right now in between these two levels here. So you're gonna have to wait and see. This could actually, even since you're below 30-week average, this could actually even roll over, test these monthly defined supports, bounce down. This could be a scenario that could be happening right now. So while Disney, although you're outperforming the SPX relatively, you're still ranging, top formation, not quite going to look at a stage 2 breakout. Could look at a stage 4 breakdown, but again, if it starts breaking down, is that the best candidate? You want the stocks that are really underperforming the baseline, the SPX, if you want to short them to have a more meaningful trade. Stocks that resist overall market downturns and they're relatively staying strong. You just want to stay away from those. You don't want to go long because the environment, the weight of evidence is not in your favor, but you don't want to short them because they're not going to give you the best return on the time that you're invested into that instrument, guys. Look at that. Huge red volume candle right here. Whoa, ninja sword. Damage and never recuperated from that. You got to really, really respect huge red volume. Something is up. Somebody knows something. And after that, never quite made it. Sideways move. Don't waste your time. You don't want to get trapped in this. You want to wait. Now you have these, you need to close above 121 on the monthly chart. You need to close below 92 on the monthly chart. And for me, those are the lines in the sands with intermediate levels right here to guide you a little bit. All right, Walt Disney, that's about it. We'll let you rest and come back to you later. Ciao, guys.